Oil prices have been subdued despite a tense geopolitical situation around the planet, but our guest today says that short-term weakness may give way to longer-term strength. Joining us now with more is Bart Malik, Managing Director and Head of Commodity Strategy at TD Securities. Bart, always a pleasure having the program.
Well, it's great to be back.
It's interesting moves and interesting times for oil right now, considering the prices have been subdued. I actually hadn't been paying attention the past couple of weeks. I'm like, all right, it's low 60s right now. We had a U.S.-Russia summit. We have Zelensky going to the White House. How much is all of that playing into the oil trade?
Well, I think it's very material, particularly in the last few weeks when the President of the United States has said that he will impose so-called secondary tariffs on the consumers of Russian oil, and that was his attempt to pressure Moscow to have some sort of ceasefire agreement and stop attacking Ukraine. Well, as it turns out, not much really has happened. We've had the summit, and ahead of the summit, prices eased a little bit because I think the view of the market was that any sort of agreement on a peace deal or a ceasefire deal, I'm not quite sure what to call those at this stage. It's not all that clear what the agenda really is, would result in less aggressive action by the U.S., whether it be secondary tariffs like have been imposed on India, who is a major consumer of Russian crude, and conversely, Russia is also a massive consumer for Russian oil. They haven't been hit, so there's a lot of ambiguity here. So I think there continues to be some geopolitical risk premium assigned to this. We think around $5 to $10, given the fundamentals.
Even at these levels, there's still risk premium in here.
Absolutely, I think there is. Right now there's ambiguity. Some are saying that Mr. Putin was the clear winner of this impromptu summit with the President of the United States. There are others who don't agree. And I think now with the Europeans and Mr. Zelensky coming to the United States in the White House, we'll see what happens. But it's entirely possible that the U.S. may start applying more pressure, and we'll see prices move up a little bit, because we may very well be concerned that there will be these secondary tariffs, sanctions. I have no more information than anyone else. We're just looking at the balance of probabilities, or it could also turn out that the president is very steadfast in his opinion, pressuring Ukraine and the Europeans to go for a deal which sees a good portion of the country being ceded to Russia, and in that case, a lot of that risk premium would go away.
Is this I know you have a thesis about the shorter term and then the longer term, so let's get in the short-term weakness. Is that what part of that thesis?
Yeah, absolutely. So what is happening short-term? Well, we're still seeing pretty challenging environment on the demand side of the equation. We're looking at maybe 650,000 barrel consumption growth this year. Next year isn't looking much better, but maybe closer to 750 or 800,000 barrels per day increase in demand. But the supply side is still pretty robust, outpacing the growth rate in demand. We of course have OPEC Plus, telling the world that they will again increase production next month. They've already increased production, we estimate, about 1.2 million barrels. That is in their attempt to try to unwind the voluntary cuts they've had of about some 2.2 million barrels. Not all of that will come through, but when you count for extra shale oil this year, when you look at crude from Latin America, including the new, Exxon project with Trinidad and Tobago. When you look at Canadian crude, I think I already said shale. There's a lot more crude chasing, not so much demand growth. And when we look out 12 months into the future, we're looking at maybe an inventory build of 480 million barrels. So that's quite a lot. We're not stressed yet, but investors are worried that the fundamentals will ultimately win over, and that's the view we think is valid.
All right, so that takes us to the next 12 months, longer term, longer out than that. What's the case for oil?
Yeah, I think we don't have to wait a full 12 months before this turns around. We look at crude at $58 average in Q4 and Q1 of next year. Because seasonally demand is going to weaken up. We're going to see these inventories start building, and we're assuming that some of that geopolitical risk will go away, and the markets will start really focusing on the supply-demand situation. Those fundamentals, and those fundamentals point to more inventories. And it doesn't really matter at some point what the geopolitics are. When you start seeing physical levels of inventories, surge in, Cushing and other areas around the globe, you will, just by definition, pay less and less of a risk premium. That is something I have been writing about for quite a while, where you can have so much risk, but markets get used to it. And the proof is in the pudding. When there is a lot of physical product out there, and perhaps some facilities are full, you can't fill it anymore, you will ultimately start paying less to incentivize less production. And the view out there is that that is exactly what is going to happen with shale, for example. I think some observers, including us, are arguing that shale production next year may very well turn to the negative side. We're already seeing drilling activity quite significantly lower this year in the key U.S. areas. After all, their break even is about $65 and higher. So at 63 today, I think there's really no reason to increase production aggressively. So yes, a lot of supply over the next 6-9 months, but then the markets will start noticing supply decreases. And OPEC is no monolith. They have always said, and I think they're true to their word usually, that they are trying to balance supply with demand. And if we're seeing prices, let's say late next year or late this year or early next year, dropping, OPEC isn't going to blindly continue to ratchet up production. They will react, and I think at that time we will start seeing a turnaround. When we look at the very, very long term, it's not all that clear there's sufficient capital expenditures that will balance supply with demand. So a lot of moving parts, and geopolitics are supportive right now, but I think that play will go away.
Quickly, I'll ask you before we move on what it means for Canadian oil. You mentioned Canadian in there.
Yeah. Now we have a pipeline to the Pacific. Most of a lot of capacity is actually going to California and others. But what has it done? Well, what it has done is, first of all, we're exporting more. But more importantly, inventories are quite low in Canada because now we're exporting more. And those differentials between Western Canadian Select, that could be as much as $25 a barrel, are now, I think, around $13-12. So not only are we exporting more, but we're exporting at a higher relative price to WTI. Now, sadly, WTI
has been lower,
has been lower, but it hasn't been as destructive as it would have been otherwise. So I think Canada looks pretty good. Things always are challenging when prices aren't robust, but I think if Canada does increase production, there is still spare capacity in that pipeline to move it to the rest of the world. I think we're going to be in pretty good shape, and my hope is that Canadians do increase export capacity to the rest of the world, and we'll see those discounts of WTI perhaps shrink even further, and that would be, a very good thing. More production and exports out of Canada at higher relative price.